This is Business Incorporated on Channels Television. Thank you for joining us. I'm Chimeze Obi Iwago. Coming up on the program, IMF says South Africa needs big fiscal effort to stabilize debt. Ghana's inflation rate rises 9.9% in January 2021. And Rwanda raises 2021-2022 budget to $3.4 billion. Let's get the show started now with intraday market numbers. And starting off here on the African continent, the JSE index in South Africa lost the most by 0.74%, while the NSE sustained the bearish run, down 0.54%. The EGX 30 in Egypt was the only gainer by 0.14%, and Kenya ended midweek session negative. And major markets in the Gulf region were in the green at intraday, except the Qatari index, which declined marginally 0.05%. On the flip side, Saudi Arabia's benchmark index rose the most by 0.28%. In the UAE, Dubai's main index advanced 0.07%, while the Abu Dhabi index was marginally higher by 0.01%. In Europe, stocks were muted this morning amid a pause in Wall Street rally and more muted trade in Asia Pacific due to the Lunar New Year holiday. Let's get details from Chelsea, standing by there, the Frankfurt Stock Exchange. Hello, Chelsea. Good afternoon. Well, Germany has extended its lockdown for 3 more weeks as officials remain worried about a third wave of infections. What has the response from businesses been on this?
Businesses are very disappointed that the lockdown is going to be extended, especially in light of the fact that we have seen cases really falling here in Germany over the past couple of weeks. So it does look like the lockdown measures that have been in place here in Germany since November are working. But what we've heard from Chancellor Angela Merkel, as well as other politicians, is that they're still very concerned that these mutations in the virus are going to start spreading much more quickly here at some point. We haven't really seen this third wave that they're afraid of yet, but they say that we need to stay vigilant until the risk has passed a little bit more. For businesses, it's obviously a blow. We've been in a lockdown since for over 3 months now, and many industries like the retail industry, bars, restaurants, hotels have all been really pushed to the brink of collapse at this point. And another 3 weeks of not being able to be open, not being able to do business is making many businesses fear for their existence. And at the same time, Germany has really been behind on its efforts to get aid to these companies. Some companies are still waiting for the government to pay them state support from November and December of last year. So the government is saying that they're going to help support the economy. Businesses are saying that they still haven't seen that support that they're being promised.
And now, German economics minister has offered state aid for companies involved in making coronavirus vaccines amid supply bottlenecks. What would that look like?
Well, Peter Altmaier, the economy minister here in Germany, wrote a letter to 9 of the vaccine makers here in Germany and offered them state aid. He wasn't very clear on what exactly that could look like, how much money there is available, but Germany clearly does want to give these companies a better chance at increasing production. Over the past couple of weeks, there's been a lot of criticism and a big focus on the fact that we're falling behind in the vaccination rate, in part because we don't have enough vaccines. So many vaccines have actually been developed here in Europe, and Germany wants to give these companies more money so that they can boost capacity. They also have proposed creating a website or some sort of terminal that companies would be able to use to say if they have extra supplies, for example, syringes or other medical equipment, and people who need that equipment could look on that supply, and so in that way they would be able to sort of match supply and demand here in Germany, which we haven't really been able to see so far. So all of this is part of this big effort we're seeing right now to boost production, but still it's going to take a while until all of those efforts are starting to pay off.
And in all the news, Amsterdam has surpassed London as Europe's largest trading centre after the Brexit transition period ended last month. Tell us more.
So I'd say this data is maybe a bit of a surprise. It's not a surprise that we're seeing trading volume shifting from London in the wake of the end of the transition period. That's in part because many EU investment firms and many EU banks now have to trade here on the continent because the EU and the UK were not able to strike a financial agreement as part of the trade deal that they struck at the end of last year. So right now, EU banks are not allowed to trade in London as they were before because the EU is not recognizing the UK as being financially equivalent. So there is a legal challenge for these banks, and so they are having to shift volumes over here into continental Europe. But it wasn't totally anticipated that we'd see most of this happening in Amsterdam. In January, Amsterdam's trading volume in stocks and derivatives rose to over 9 billion euros a day. That's up from just over 2 billion euros a day in December. So it was a huge influx of money. I think what the big question is now is how long that's going to last, if this is a permanent shift. And many traders and analysts say that it's going to depend on what kind of deal the UK and the EU can strike on financial services. If they're able to make that kind of deal, perhaps we could see some of these trading shifts reversing at some point.
Well, Chelsea, COVID-19 and, of course, the vaccine rollout remain a top conversation. And let's continue to keep a track on those and see how those will be driving the numbers out there in Europe. Enjoy the rest of the day. And in the UK, FTSE 100 is boosted by strong Astrazeneca results as Astrazeneca shares rose 1.7% this morning. Well, let's get more from Juliana. Good afternoon, Juliana. Well, this morning we talked about a couple of earnings, AstraZeneca, Royal Mail and so on. But AstraZeneca says it plans to adapt the COVID-19 vaccine it developed with Oxford University to new disease strains within 6 to 9 months. How is that being taken considering that AstraZeneca's vaccine didn't work for the South African variant?
Oh, it's good news, really positive news. That's how the British media are pushing it anyway. If you think about it, we're in February now. This time last year, all the big pharmaceutical giants were racing towards trying to find a vaccine. They've done it in such a short period of time. And I think AstraZeneca, certainly their CEO who is giving out this new information alongside their annual results, they've been really careful about the terminology. I presume they don't foresee that it didn't work for the South African variant, but the efficacy wasn't as high as it has been for other variants. So, for example, the Kent variant in the UK, preliminary clinical trials does prove that it still works against them. However, nevertheless, they have said that they are going to adapt the vaccine, so they're not starting from scratch. They will do that after they've rolled out the AstraZeneca Oxford University version 1, if we should call it that type. So they'll start clinical trials in spring. They expect them to be out and rolling in September. So I suppose that's good news, particularly for low-income countries. We know at the moment there is a vaccine war going on. Cyril Ramaphosa, the South African president, he was, pretty honest when he spoke at the World Economic Forum a couple of weeks ago, saying that richer countries are hoarding all of the vaccines. We know that AstraZeneca, in comparison to the Pfizer one, is much cheaper. It's easier to store. So fingers crossed Africa can get their hands on that as soon as possible, because they're seriously lagging behind. But some other information that was discussed is that they will be producing 100 million doses of their vaccine this month. They are going to double that to 200 million. That's eye-watering. They have released their end-of-year results showing that profits and revenue both increased between 10 and 11%. I suppose what everybody was waiting for was how much has this vaccine made you? They carefully decided not to mention that. They said they'll be giving those results out in Q2.
All right, in another corporate news there, Shell has vowed to accelerate its plan to become a net zero carbon energy company by 2050, but will continue to grow its gas businesses. How will this play out, really?
Interesting story here. Ben van Beurden, Royal Dutch Shell's chief executive, has been speaking earlier today in front of investors. I think the headline really that everybody's taken away is the fact that he has said, oil production peak is over, that the peak has happened. I believe he put it to 2019. He said that was the peak of oil production. And from now on, oil production will reduce by 1 to 2%. It sounds small, but anyone within the industry knows that that is a pretty big deal and will have serious ramifications. Of course, just like BP, Royal Dutch Shell are an oil juggernaut. And, even the talk or the thought of such a huge, dirty oil production company, getting and hitting those net zero emissions is going to be tough. But I think a lot of observers wanted a little bit more. He's stuck to the plan and the strategy of making the company a net zero emissions a company by 2050. Problem is that's 30 years time, and at the moment the climate emergency and a lot of the bellowing and talks is happening now. So for 30 years for the company to say it's going to transition is really tough. As you mentioned, he did say that he is going to be expanding some of their gas exploration. He also spoke to investors saying that he is going to try to maintain the dividend at 4%. I've got a little bit of his statement which I'll very, very quickly read, Chimezie. He said our accelerated strategy will drive down carbon emissions and will deliver value for our shareholders, our customers and wider society. We must give our customers the products and services they want and need, products that have the lowest environmental impact. It's just whether or not the industry are going to wait 30 years for Royal Dutch Shell to do that, which is why I think their shares are down at 2% at intraday.
Right. Now, looking at the market itself and then, of course, all these corporate news on the wire, how is that driving the market? What's the update on the market this intraday?
Yeah, well, after Van Beurden's statement, Royal Dutch Shell, they're one of the biggest fallers, down at 2% at intraday. But as you said, we've had some big corporate juggernauts release their data. Astrazeneca, Coca-Cola, Uber Eats, all doing exceptionally well, which is why at intraday the FTSE All Share is up 0.06%. The FTSE 100 also up by 0.02%. And the FTSE 250, the domestic market, that's down 0.20%. In currencies, the British pound is down on the US dollar by 0.09%, down on the euro by 0.18%, and down on the Japanese yen by 0.01%, Chime.
All right, we'll leave it there. Enjoy the rest of the day, Juliana.
Thank you.
And trading in Asia Pacific was muted today as multiple major markets in the region were closed for holidays. Hong Kong's Hang Seng Index rose 0.45% on the day to 30,173 points, while the Straits Times Index in Singapore closed little changed at 2,925.48. Markets in Hong Kong and Singapore ended their trading day earlier than usual at the eve of the Lunar New Year. In Australia, the S&P ASX 200 finished its trading day 0.1% lower. MSCSI's broadest index of Asia Pacific rose 0.2%. Markets in China, Japan, South Korea and Taiwan are closed for holidays. And U.S. stock index futures rose in early morning trading today as markets look to continue February's momentum. Futures contracts tied to the Dow rose 51 points. S&P 500 futures and Nasdaq 100 futures also traded in mildly positive territory. The move comes after the Dow advanced 63 points during regular trading hours to close at a record high. The S&P 500 and Nasdaq composite also hit record highs during Wednesday's session, but the indices couldn't ultimately hold on to those gains. And oil market prices fell earlier today, giving up some of the recent strong gains, although losses were curbed by production cuts and hopes that rollouts of vaccines will drive a recovery in demand. Brent crude fell 0.6% to $61.08 a barrel, while U.S. crude slid 0.6% to $58.33 a barrel. Crude stocks last week fell for a third straight week, dropping 6.6 million barrels to 469 million barrels, their lowest since March. Brent has risen for the previous 9 sessions, its longest sustained period of gains since January 2019. Okay, we'll take a break, and when we come back, we'll look at the metals market, and that's on our commodities market update. To stay with us. Precious metals like gold, silver and platinum have been recognized as valuables for a very long time. In times of high inflation, there is a typical flight to safety, and investors usually abandon the dollar in favor of precious metals. Okay, let's talk more about this with Belumi Oshode, one of the research analysts with Financial Derivatives Company. Good afternoon, Belumi. Thank you very much for joining us on the program.
Good afternoon. Thank you for having me.
So in the last year, we have seen the dollar lose some grounds and a rally in gold in particular. Now, diamonds have been unaffected relatively by this movement until recently. So is there any reason for the recent interest of investors in diamond? Remember, they say diamonds are a woman's best friend. How about that?
True. Actually, in times of uncertainties like this, investors, or let me say economic agents generally, actually look towards a safe haven, and it's expected because everybody wants to store their value. One of the characteristics of money is store of value. And when we see that there's weakness in the currency, for instance, Nigeria has lost about 25% of its value of naira. So people naturally tend towards precious metals such as gold, silver, and diamond, etc., just to save and to store their value. So this is one of the reasons that has triggered, this increase in demand for diamond in recent time. And more particularly for diamond, December last year, we saw about 190% increase in the demand for diamond as against what we had in 2019. This is because towards the end of the year, there was a lot of, there have been a kind of a built up demand, during the lockdown. People could not, demand for diamond. People could not buy accessories because of restriction in movement and what have you. So towards the end of the year, people started coming out to demand for diamond, and this has actually raised the price of diamond. Secondly, the fact that this new normal that we find ourselves, the fact that we have embraced these virtual meetings, Zoom meetings, and the likes, we also saw that there's an increase in the demand for polished diamond, particularly stored. We see people trying to adorn themselves to look very okay when they appear on the screen, having meetings, virtual meetings, and all that. So that also has led to an increase in the demand for diamond, like we see in recent time. And of course, lastly, the fact that retailers now embrace virtual or online buying, as against what we had before, prior to the pandemic. So all these factors, coupled with the fact that there is low interest, central banks generally adopting low interest rate environment, which is not good enough for investments and yields and all that. So these are the factors that have driven the demand for precious metals in general, and diamond is particular in recent times.
Now, there are fears of overheating of the U.S. economy in 2021, and of course inflation is rearing its ugly head again after many years of being subdued. What do you think will happen to the price of precious metals as inflation picks up and interest rates increase in 2021 and 2022?
So inflation rate in the United States has risen up to a record high of about 1.8%. This is more than, this is above what has been in the past, and this is causing jittering amongst investors, and skepticism and all that is actually high. So because of that, we will see that over time, go to ending of this year, 2021, we will expect that interest rates would increase. And if that happens, what that means is that the value of dollar will be strengthened. And if the dollar is strengthened, of course, there will be automatically a drop in the price of all these precious metals, because there's an inverse relationship between precious metals and the value of dollar. As dollar weakens, precious metal increases. So we'll see this relationship play out. And what that would mean is that there'll be a decline in value of gold, silver, and all other forms of precious metal. And for us, Nigeria, some of our reserve is actually in gold, and so that would actually affect us. And we've seen a sort of bubble in the commodities market in recent time because of all the uncertainties around. But as interest rates increase, US interest rate increase, the dollar strengthened, there will be a decline in demand for precious metal going forward.
Now, the world's largest producers of diamonds are Russia, Botswana, and Australia. Now, these three countries are projected to grow by about 2.5%, 8.7%, and 4% each, this year. So what will the impact of the recent price surge in diamonds do for their respective growth prospects and their economies in general?
Okay, so it's actually to the advantage, although it's in the short term, but it's the advantage. Taking, for instance, Russia, which is the world's largest producer of raw diamond, it actually experienced a surge in the demand for diamond even early this year, demand for diamond increased about 30%, and that's actually boosted external reserve, boosted foreign exchange earnings, and gave a better balance of payment position. And this, of course, will have a positive prospect on the growth rate as the sector, yields better and have, turn out to be a very active sector with a high, contributing high to the GDP value. So it's a very good prospect for these countries.
Right, Belumi, thank you very much for your time.
Thank you.
And the International Monetary Fund says South Africa requires a growth-friendly yet sizable fiscal effort to stabilize and lower its debt burden, reduce country risk premiums, and improve investor confidence. According to the IMF, the COVID-19 pandemic exacerbated South Africa's existing vulnerabilities, which means tackling long-standing fiscal and structural challenges is more critical than ever to set the stage for a robust recovery and pursue strong, durable and inclusive growth. The IMF trimmed its forecast for South Africa's 2021 economic growth to 2.8% from 3% and sees expansion at only 1.4% next year. The country took out a $4.3 billion loan from the lender in 2020, its first from the organization at a sovereign level. And latest data released by the Ghana Statistical Service indicates that the average price of goods and services across the country increased by 9.9% year-on-year. The rise in the inflation rate for January 2021 is, however, lower than the rate recorded for December 2020 by 0.5 percentage points and returns the country's inflation rate to within the medium-term target band. Variation between food and non-food inflation stood at 5.1%, with food inflation recording 12.8% and non-food inflation recording 7.7%. And Rwanda has announced plans to increase its 2021-2022 budget by $220.8 million to $3.4 billion from its initial $3.2 billion as the government battles disruptions from the global COVID-19 pandemic and seeks to revive the economy. The budget, primarily funded by domestic revenues, projected to increase from $1.6 billion to $1.7 billion, will majorly spread across the education sector, followed by the health sector, to enable infrastructure expansion, purchase of equipment, and staffing occasioned by the global health emergency. It will also be funded by external resources totaling $1.3 billion, with $596.9 million mobilized from grants and $772.5 million acquired through foreign debt facilities. However, the proposed changes are still subject to approval by Parliament. And that's a wrap on the program. Thank you for watching. I'm Chimize Obi Iwagu.